Okay, so what have we covered so far? We've covered long call and long put. We have covered short call and short put. We have covered vertical debit spreads. I've told you why we don't do ratio spreads and butterflies. We'll talk about synthetic and vertical credit spreads. So before talking about synthetics, I want to go directly to vertical credit spreads because they are much more important as a strategy as compared to synthetic positions. All right, so let me just all right, 1 minute, guys. Section 4 strategies are vertical credit spreads and iron condors. Iron condor is a non-directional strategies we'll cover later today itself after we finish with synthetics. Vertical credit spreads are strategies that need to be taken in section 4 and are primarily option selling strategies. Okay, the bullish version is called as a bull put spread and the bearish version is called as a bear call spread. All right. Bull put spread. Okay, this is a credit strategy and a bullish strategy. Script is in an uptrend and trading in a demand zone. The implied volatility implications are IV is in section 4. We will benefit if IV comes down to section 3, that is the mean. But in case IV does not come back and keeps on rising, we are in danger. So the offset unit here is what will provide us protection in case IV does not revert to the mean and keeps rising. Is this clear, guys? Okay. So the danger is that IV might drop. When IV drops, we will lose in our position. But if IV increases, that is anyways going. Sorry, if IV increases, that is going to hurt our position. If IV drops, that is going to anyways help our position. Okay. The risk reward characteristics are limited risk and limited reward. Break even is anchor strike minus premium. No, limited risk and limited reward, not high risk and low reward. You see this graph, right? Don't go by the distance of this graph. That is the graph at expiry, remember. Okay. The risk is limited, reward is limited, break even is anchor strike minus premium because we are using puts to get into this strategy. Delta is positive here. Why? Because we are in a bullish strategy. Theta is positive. Why is theta positive? We are selling. We are selling options. Not Rahul. It is not because we are bullish. We are selling options. That's why theta is your friend. Remember that. Delta is positive because bullish strategy. Theta is positive, delta is positive, and vega is negative. Why is vega negative? Yeah, you are selling options, and an increase in implied volatility will hurt your position. Yeah. So because you are selling options, remember Vega is positive when you buy options, negative when you sell options. Similarly, theta is negative when you buy options and positive when you sell options. Correct. Enemy. Okay. Now bull put spread. The trade action is in section 5. In section 5 bullish strategy, what do you do? What is section 5 bullish strategy? Can anybody tell me? You sell puts. So you will still do the same thing. You will sell the same put option. The strike is going to be out of the at or below the demand zone, which is going to be out of the money put option. And now after you sell that, because we are in a volatility condition 4 and we run the risk of volatility going in section 5, what you do is you simply buy a put option here below the strike price of the sold put. You go and buy put, no call. You sell a put option. How much below? I'll tell you, Rajiv. You have to sell this, you have to select the offset strike in such a way that you get a minimum of 0.25 delta for the net position and Vega of minus P. The Vega of minus P is half of the Vega of the bull put is half of the Vega of minus P. Vega of bull put, the Vega of this strategy. So this combined will have some Vega, right? Minus Pn plus P. That value should be half of the anchor unit. Yeah, the net Vega should be half of the anchor unit because that is when we have tamed the impact of volatility. Make sense? Now, since this is a credit strategy, you have to stay within 60 days. Remember that. Since it's a credit strategy, you have to stay within 60 days or less. So usually it is the front month that you look at, and the parameters are the other parameters are the net Vega should be at least 0.25 because we are having a directional strategy, and the Vega of this bull put should be half of the Vega of short put. When I'm doing the RR calculations, I will explain this practically, this part. All right. Right now, just understand that the Vega of this whole position should be half of the Vega of the anchor unit. Is that clear, everyone? Okay. Strike selection. Strike selection is simple. AOA, AOB at or below demand, and the offset unit is further below the All right. Welcome back, everyone. Thank you, Baba, for typing that message. Can you please confirm if you can hear my voice and see my screen? All right. Thank you, guys. Thank you, Bhavya, for putting that note. The recording is on, don't worry. All right. So let's. Where were we? We were on this. Just lost track. I think we were on the next strategy. Okay. Next page. So, are the trade parameters clear to you guys? Offset unit price. Okay. Strike. So, offset unit strike should be below the anchor unit strike, and vega of the entire position should be half of the vega of the anchor strike. All right. And this I will explain you once we go into the RR calculations. With practically, I'll explain you that will be easier for you to understand. Okay. Close if target or stop is met based on the underlying price. Again, close if the short unit is trading for 10% of the premium. Credit strategy is always, it is going to be the moment only 10% is remaining, you get out of the trade. And you will not evolve this. Section 4, when it moves to section 3, most of the times you would have got your profits. So usually, these credit strategies like short call, short put, bear call spread, and bull put spread. These strategies are really good when you can execute them 3 weeks to expiry. Like say at the end of March, first week, if you execute right. So by the time volatility drops and by the time the stock starts moving into your in your favor, you would have got the credit. So these three strategies, along with the non-directionals, are the ones which pay you the most. Yeah. So for example, now February is gone. So generally, if I find a good strategy in the first week of March, end of first week of March, then I like those strategies. Of course, provided all your core strategy rules should be met. The credit strategies, Arun, credit. All right. Any questions, anybody on this? Yeah, 27th or 20th March. I'm just giving an example. The March expiry is an example. Let's take the same example here. So in section 5, in the same at the same demand zone, we were selling the 100 put option, isn't it? Yes or no? like everybody is looking at the market और market से उधर ही खड़ा है 4 पॉइंट प्लस 2 पॉइंट माइनस 4 पॉइंट प्लस 2 पॉइंट माइनस तो जवाब दो ना सर ताकि हम जल्दी जल्दी आगे बढ़ सके Welcome back, friends. Can you please confirm if you can hear my voice? My sincere apologies for this, but as I said, these are conditions beyond my control. All right, thank you guys. Let's go ahead. Now, in no, Murugan, not like that, not like that. What I am trying to tell you is, so the strategy allows us to, let's say now we are in the end of February. So the front month expiry is March. Okay. The next month is April. Now, what does this strategy tell us? That you can choose up to April expiry, correct? 60 days or less. Okay. So what I'm trying to tell you is, personally, what I have seen is that with 3 weeks, if you get a trade with 3 weeks to expiry, let's say at the end of first week of March, I find a bull put spread, which I can execute. I like those strategies because within 3 weeks you get those returns. Got it? Not that your results are always going to come in 3 weeks. Because anyways, the options are going to expire worthless. Remember that at expiry. And we are anyway selling out of the money options. Yeah. Yeah, of course, of course. Prem says, can we use this offset unit technique for naked bull put? What is naked bull put? Prem, what do you mean by naked bull put? Prem, can you hear me? Correct. So you're saying, can I do bull put in section 5? Yeah. So you're saying that instead of doing short put in section 5, can I do bull put in section 5? Correct? Yes, you can. But your rewards will be little lesser. But that's a trade-off. All right. And so bull put spread in section 5. Yes, that's why Anil I said right that your reward is going to be less in that case. But then in the beginning, you should always, instead of doing naked shots, you should always look for bull put and bear call, because that will any. I'll tell you the reason why. Okay, till you are comfortable with core strategy, right? You still run a risk if you try to do a naked short. What if the stock gaps against you? Isn't it? What if the stock suddenly gaps against you? So to prevent that in the initial period, to prevent those unlimited losses, and you know what is going to happen when the stock gaps up against you? Your psychology won't allow you to take the stop loss at whatever price. You will say, मेरे करण अर्जुन नीचे आएंगे, मेरा लॉस कम हो जाएगा. ये होप कोई छोड़ता नहीं है. 10%, Pavana. Okay, so that's why avoid naked shots in the beginning. Just do paper trading for naked shot. But at the same time, instead of doing naked shots, what you should do is you should do bull call spread instead of sell call, and instead of sell put, you do bull put. All right. So in this bull put spread, in section 5, what you would have done is normally you would have only sold 100 put option. But in bull put spread, you will add the 80 put option below that. You will buy the 80 put option. So in case volatility keeps on rising, so whatever you lose in this minus 100p, you will gain in the plus 80p. All right. Now again, this is the same. So you need a minimum delta of plus 0.25, and whatever theta vega you get, you should be okay. Now if you see this, what was the anchor units? So this is the anchor unit. What was the vega of this anchor unit? Close to 0.11? Yeah, 0.12, 0.11, 0.12. So now after adding the offset, the net bull puts vega has dropped down to 7 paise from 12 paise. Close to. Arey Prem, you can zoom your blackboard as well. Now for the bull put, it is 0.07. So has it come closer to 50%? It need not be exactly 50%. It has to reduce, come closer to 15%. 50%. So that is the rule. So you have to keep on adjusting the offset strike in such a way. So let's say first I sold 100 put option and then I chose two strikes below, that is 80. And when I look at the Greeks, am I getting minimum 0.25 delta? All right. Is my Vega half of the anchor unit? All right. Then my offset is correct. I don't have to bother. So these two plus the RR will tell whether the offset is right or not. Yes, net Vega of this entire position has to be approximately half. Approximately half. All right. Are we done with this? That's bull put spread. Now similarly, this is bear call spread. This is at supply. Bull put is at demand. Bear call is at supply. So whenever you are in a supply zone which is tradable and you want to trade, and the IV is in section 4, you will execute a bear call spread and not a short call. Why? Because IV can still move up to section 5 and that can hurt your position. Potential benefit from IV reverting to the mean. The offset unit provides protection in case the implied volatility does not revert to the mean and keeps rising. Risk limited, reward again limited. Break even is anchor strike plus premium. Why is break even anchor strike plus premium? Because we are using call option. Absolutely right. Why is delta negative? No, Rameshji, anchor strike plus premium is because of the call spread, and delta is, so you're saying delta is negative because we are bearish, right? Correct. So delta is negative because it's a bearish position. Theta is, why is theta positive? Because we are selling options. No, not call Ramesh. We are selling options. We are selling options. So time is our friend, not enemy. And why is Vega negative? Yeah, because we are trading in section 4, and can volatility still go up further? Not drop. Rise. You are selling options. Selling options. Drop is in your favor. Rise is against you. When you sell options, see, volatility helps the long options guy and hurts the short options guy. Here we are in a credit strategy. Volatility rise is going to hurt us. Volatility drop will help us. Look at this. Potential benefit from IV reverting to mean. Offset unit provides protection in case IV does not revert to the mean and it keeps rising. So in section 5, you would simply sell a call option. Yes or no? So because we are in section 4, once you sell the call option, above that you go and buy the offset unit, which is again a call option. And remember, in both cases, expiries are going to be the same. Again, the parameters are the same, 60 days or less, minimum minus 0.25 delta, and Vega should be half of Vega of the bull bear call spread should be half of the short call. Anchor unit at or above supply, offset unit above the anchor unit. Maintenance close if target or stop is met based on the underlying price, or the short unit is trading at 10% of the options premium, and you will not do any evolution in this case. Yeah, correct. So evolution you should do from section 5 to section 4. Don't do from 4 to 3. Only do it outside, from outside to inside. From section 1 to section 2 you can do evolution. From section 5 to section 4 you can do evolution. But if you are in section 2 when you took the trade, so and you drop down to section 1, there you don't do evolution. Hey आनंद, क्या कल से ध्यान नहीं दे रहे हो क्या तुम? ये 4 बार रिपीट कर चुका हूं मैं, 10% ऑफ ऑप्शंस प्रीमियम. 5 रुपए के लिए आप काम करोगे क्या? Yeah, Shrikant, you unwind it only at your target. Anand, 10% remaining, which means 50 का अभी 5 रुपया हो गया है. 5 रुपया कमाना चाहते हो या 45 रुपया कमाना चाहते हो? या फिर 10, if the short unit is trading at 10% of the premium means आपने 50 में बेचा तो 50 का 10% क्या है? 5 रुपया. तो जब 5 रुपया हो जाएगा ये ऑप्शन का वैल्यू तभी एग्जिट करो, जीरो होने तक वेट मत करो. That's the same example. In section 5 you would be selling a 5900 call option, but because you are in section 4 you go and add a offset unit at 6200 because IV is in section 4. And now take a look at these. Is my delta maintained to minus 0.25? The minimum criteria of delta. And Vega, so if you see the anchor units, Vega is 6.37, the offset is 3.77. Have we tamed it by 50%? Yes, that's it. Is that clear now? Yeah, it's okay. No, it need not be exact 60%. Let's go to the non-directional strategies now. Mr. Chandra, it is not in my hand. The market conditions should be valid for us to do that. दोनों अच्छे थे यार, मांजरेकर भी अच्छा था, तेंदुलकर भी अच्छा था। लेकिन तेंदुलकर तेंदुलकर तभी बना जब वो पिच पे जाके पहले खेलने की हिम्मत की उसने। बिना हिम्मत के कैसे तेंदुलकर बनोगे यार? Okay, any questions, guys? Or should we move to the next setup? So we have to complete three more strategies and then we start with our RR calculations. All right, let's go ahead. Yes, non-directional is sideways trend. Another very interesting application of options is trading non-directionally. Okay, so in a sideways market, how can you trade stocks or futures? You'll only do it at the extremes provided you have reward to risk ratio. Correct? You need to also have reward to risk ratio. If you don't have reward to risk ratio, you can't trade them. Okay, when doing so, we are basically betting that the script will remain in a price range at or before expiry. So what we bet is, since the stock is ranging, it will probably remain in that range till expiry. Okay, in this case we sell premium. We sell premium and wait for it to expire. As long as the script remains in that range, as long as the script remains in that range, we will be fine. If the script breaks the range on either side, then we are going to lose money, or we're going to go for a stop loss. Okay, being non-directional can be seen as being bullish and bearish at the same time, isn't it? So at the lower end of the sideways movement, bullish; at the upper end of the sideways movement, bearish. Therefore, the range should be defined using supply and demand, since the expectation for the price would be to move down when hitting supply and to move up when hitting demand. These bounces would create the possibility for the script to remain a few more days inside the range and therefore hopefully stay there until expiry. So now the best part about these non-directional strategies is the weekly expiry for Nifty and Bank Nifty. That's where my study is going on. In weekly Bank Nifty and Nifty expiry, especially in these sideways market, they give you good opportunities to trade these strategies. Short strangle. This is a credit strategy and is a non-directional strategy. Short strangle is a credit strategy and a non-directional strategy. Script is ranging between key levels of supply and demand. IV is in section 5. Potential benefit from IV reverting to the mean after an extreme rise while receiving theta. So this is a pure theta play. Uh, During panic, market participants often buy options for more than what they are worth, and that is to your advantage. Now, if you think about this, in section 5, sideways is what? Bullish and bearish? Both? Correct? In section 5, what is the bullish option strategy? Sell put. What is the bearish strategy in section 5? Sell call. When you do both these together, it is short strangle. You sell a call, you sell a put. That is short strangle. Sell call above supply, sell put below demand. That means you're combining both the bullish and bearish section 5 strategies together and forming short strangle. You're strangling the price between those two regions of supply and demand. Isn't it simple now? Yeah, it has two legs, both are shorts. Okay, the risk is unlimited on either side. So here, see, in the non-directional, no, Anand, you have to execute at the same time. So remember, we are not looking at individual legs. Our assessment is on the overall short triangle, both together. Okay, and since we are trading in a range on the supply side and the demand side, you could get stopped out on either side, right? Yes, that is possible, Amit. No, it won't. Why will it hurt? वैसे तो स्टॉक बाय करोगे नीचे नहीं जाएगा. When you buy a stock, will not go down. Can it not go down? It can. So will you stop trading? Because if it goes on, isn't it going to hurt? No, it won't hurt double. It will hurt double only when IV increases and you get stopped out. That is the only time you will get hurt double, more. You get stopped out as well as IV goes up. That is the only time when you're going to get hurt. सब स्मार्ट लोग हो तुम लोग, बट मुझे कंप्लीट करने नहीं देते. तो अभी से मैं सजेशन देने वाला हूँ ओटीओ को, बस थोड़ा सा दे दो इनको. ये लोग सब प्रीएम्प्ट कर देते हैं बिकॉज इनको सब आता है. मेरा काम आसान हो गया ना. Fifth day, Anand, you're still doing. I still have to go to the next slide, and before that, you're going to do this. It's not about getting angry. It's about getting frustrated. That's it. Don't feel bad because, but I am a very blunt person. I won't mix words. Sometimes come and sit on this side of the screen, and then you will understand what I am talking about. Managing 50 students, that too online. I know we all have a certain level of IQ and we can anticipate, but that doesn't mean you keep on writing it. I don't consider you guys dumb. Based on your responses, I can ensure that you guys are smart enough to anticipate because this is all logical stuff. So if you have common sense and logic, right, everything makes sense. The risk is unlimited, reward is limited to the amount of premium that you have received. Break even is anchor strike plus or minus premium. Okay, now what is plus or minus premium? You are going to have stop loss on both sides in non-directional. You could get stopped out on the supply side or you could get stopped out on the demand side. Is it correct or wrong? You could get stopped out on either side, right? So you are going to have break even points on either side in non-direction strategies. Okay, so your upper break even point is strike price plus the net premium, and your lower on the put side, on the demand side, your stop loss is put strike minus the net premium. Is that clear? Anchor strike plus minus premium. Yes, you have to square off everything, Bhavya. Once you get stopped out or reach your target, right? You have to square off everything. Now, non-directional strategies will have delta neutral because we are not betting on direction. We are betting that the stock will not get direction. Yes, any side you get stopped out. Either, see, logically, just hold on to your questions. Okay, the next slide will clarify all these questions which Bhavya asked. The next slide will tell you, and it's very, very logical. Okay, just pay attention to this. The delta is neutral. Why is delta neutral? Because you're betting that you will remain in the range and there is no direction that is got by this trade. you don't get a direction. Is that clear? Because you're ranging. So that's why delta is going to be neutral. This is a delta neutral position. So delta is not going to pay you, not going to hurt you. Delta will never pay you, but delta can hurt you if the range gets broken and the trend gets established. Yeah, delta will be less than 0.25 in this case. 0 is better. But you will never get 0. Okay. Theta is positive. Why? Because you're selling options here. This is a credit strategy. So theta is always going to be your friend. Vega is going to be negative and high because first of all, you are selling options in section 5. What if the volatility increases? It's going to hurt your position. That's why it is negative. And what if volatility drops? Will it help your position or hurt your position? Volatility dropping is going to help your position. Volatility rising is going to hurt your position. Remember that. Correct, because volatility dropping will reduce the premium, which is good for an option seller, isn't it? Yeah. And this is how the graph looks like for an short triangle. So look at this. Is this what you do in section 5 above supply zone? Bearish strategy minus C at or above supply? Is this what you do when you are bullish in section 5? So when you are in sideways direction, you do both together. Sell the call, sell the put. And the most optimum time to enter this is when you are at the center of the between the two zones. In between the two zones, that's the most optimum time. Why? Because you get the optimum value for call option and optimum value for put option. The best part about non-directional strategies is you can enter anytime. There is no entry point restriction. So the preferred way is to enter in the middle. Then you get both the values as optimum values. Correct. Okay. Again, since you're selling options, parameters are still the same, 60 days or less, and your delta has to be less than 25 and greater than 0. That's the only change in delta condition. Anchor at or above the distal line of the supply zone used to define the range. In this case, there are two anchors. Both the call and the put are going to be your anchors. Remember this. Okay, so this is at or above supply, this is at or below demand. Maintenance close. If either of the side range is violated, you have to close both the units, not only one. Now let's say the stock was doing this, ranging for some time. When the stock is ranging, are these options out of the money? Yes, these options are out of the money. So if time passes, are these going to reduce in value, both of them? Yeah. And let's say this guy stops you out on the demand side. When this drops, is your call premium also going to drop? So most of the times in non-directional strategies, when you get stopped out on one side, the other side would have already paid you a lot of money. So if it stops out here, this would have reduced in value, thereby giving you, but whatever you have gained here, you're going to lose in this. So usually the losses are a little bit lesser compared to the other strategies. But It also depends on when you get stopped out. If you get stopped out immediately after entering, right? Immediately after entering, then the losses are as comparable as the other strategies. Okay? No, theta is the only one which is paying you here. Theta, and then what? See, if in credit strategy, theta will always pay you. He is your best friend. Yeah. So the longer the stock remains in the range, the better you're going to do it. Yeah. If stopped out immediately, Manesh, yes, theta will not pay you then. You're right. Absolutely right. Yeah. My mistake. I didn't get it properly. Yeah. So these are the strategies where you can get stopped out in profits. I told you right on the first day that options have strategies when you there are chances that you can get stopped out and still be in profit. It is these strategies. Credit strategies are the only strategies which can pay you if you get stopped out, because it depends on when you get stopped out. Does it make sense to you? Yeah, these are simpler strategies. Okay, range is violated, get out of both. Total premium is, so whichever unit is trading at 10% or less. Okay, so here you can exit gradually. Let's say we are ranging here, or we slowly have gone up to this after a certain period of time. So this is also reduced, and this has now become 10% of its premium. So let's say here you sold, you got 20 rupees, here you sold, you got 15 rupees. So now this 15 rupees has become 1.5. Exit this P, and the moment this becomes 2 rupees, exit this P. C. And you will evolve if it moves to section 4. Yes, so you can exit both at the same time, or Prem, after a certain time is passed, right? After a certain time is passed and you're getting closer to expiry, and let's say stock is on the supply side, then first you exit the put side, wait for this to drop down a little bit, and then exit from the call side. That is also possible, but only when stock has spent a lot of time in that. All right. So this is that example. In this case, that's your supply, that's your demand. So minus 1500, minus 5500, assuming that the stock is non-directional and volatility is in section 5. Delta has to be less than 0.25. Theta, whatever you get. Vega is whatever the net Vega is of both the positions. That's it. No, it is not after how many swings, Manish. It is generally how many days have passed. Yeah, stop loss Anand will be on both sides, either on the demand side or on the supply side. Yes. Now, I just want a quick 5 minutes break, but you are not going to get a break. What you are going to do in these 5 minutes is, this iron condor is an adaptation of short strangle because it is in section 4. Just like short call, short put, bull put. Similar, this is that. I want you to just read these. You might, all of you will have the manuals. Go through this strategy. I need a 5 minutes break because I have to attend to someone here. Okay, so I'm just going to mute it. You guys read through this, okay? And then I'll explain it. Just 5 minutes. Short triangle. Alright guys, I'm back. So have you guys gone through the strategy, which is iron condor? So what is the difference between an iron condor and a short triangle? So one is IV section, the other one is you just add an offset. So from unlimited risks on either side, you change it to limited risks on either side, isn't it? And the best part is you can do this in both section 4 and section 5. So naked options, since they involve unlimited risk, you don't want to do those things. These are the better ones. Just that your reward is, so instead of getting 10% return on your investment, you might get 8% or 7%, but then it will protect you from the headache of what if tomorrow it gaps up. So this short triangle you would usually do when you are really good about supply and demand, and that, so you can anticipate when will gaps occur, when will gaps not occur, all those. When you're perfect, then you do short triangle. Till then, in section 5 you keep on doing iron condors only. All right, so I'll just read through this quickly, and if anybody has any questions can go ahead and ask me. Again, this is script is ranging in between key levels of supply and demand. Instead of IV being in section 5, IV is in section 4. Potential benefit from IV reverting to the mean. The offset provides protection in case IV goes back to section 5. Yes, Harish. अगर पैसा अर्न नहीं होता तो रखते काय कोई, अब बताता क्यों मैं तुमको. You make money. Risk limited, reward limited. Again, break even is similar to that. Anchor strike plus premium on the call side, anchor strike minus premium on the put side. Remember, in these non-directional strategies, you will have two break even points. Delta again neutral, less than 0.25 and greater than 0. Theta positive because you're selling options. When you're selling options, time is your friend. Vega is negative. Why is Vega negative? Yeah, so IV can go back to section 5, right? No, no, Anand. Nothing like that. So I'll tell you when. So usually non-directional strategies are applicable when a stock comes and sits in a monthly demand or a monthly supply, because you know when the stocks come and just a minute, guys. So usually, do you know that when stocks come and sit in the monthly demand or stocks come and sit in the monthly supply, they're usually trend sideways. That is the time when you do these. See, the problem until election is going to be this, Omkar. Volatility will start rising now till the election results are out. Okay. So these are good strategies till the elections, but the wait period to make the profits is till expiry. So you will have to wait till expiry. In normal scenarios, you did not have to wait till expiry, but in during these scenarios you might have to wait till expiry because the volatility will only drop down as you get closer to expiry. Direction is there, yes, but does the stock completely move out of the demand zone? So the best way to understand is usually when it comes and sits in a daily demand zone, right? In a monthly demand zone, it will keep oscillating between its daily demand and supply. So when you see that first time the daily supply has hit and it's come down, that is the time you keep on doing this. Yeah, 60 days or less. Usually front month is the best. So all my credit strategies mostly are in the front month. And if the front month does not provide me good, what do you call, reward to risk, I will wait. I will not be in a hurry to take the next month now. So I'll wait for to get closer to this month's expiry, current month's, to see whether my conditions are still remaining the same. Because 60 days or more than